The answer is complicated, and analysts' view might not be entirely aligned with HSBC's official line. So on Thursday, HSBC announced this surprise bid to privatize Hang Seng Bank, a subsidiary it currently owns around 63% of stake. Essentially, the UK lender will need to buy the remaining 37% shares from minority shareholders, taking full ownership of the unit it acquired 60 years ago. So the timing raised some questions. Its target, Hang Seng Bank, is struggling to contain its bad loans stemming from Hong Kong's years-long property slump. It reported a 30% plunge in its interim profit on July 30th and a non-performing loan ratio of 6.69%. Some analysts think HSBC is finally taking the move to save Hang Seng Bank, with the privatization essentially giving it more flexibility to manage the capital and financial ratios. But given the size and significance of this deal, in which HSBC is spending $13.6 billion to buy the remaining shares, some analysts agreed with HSBC's official line that the reason should be broader. It's about investment for growth, they said, especially when the bank is seeking business growth. HSBC said the acquisition will create business synergies as part of the sweeping overhaul of the CEO, Georges Elhedery, has overseen since it took office in September 2024. The CEO highlighted enhanced earnings, revenue, and cost upsides through more product offerings, a stronger international network, and consolidated capabilities in areas such as insurance, asset management, markets, and technology. In a way, it will avoid some competition between Hang Seng Bank and HSBC in the local Hong Kong market. So HSBC put out this offer, and now it's up to the minority shareholders of Hang Seng Bank to decide. The bank said the shareholders are expected to receive a detailed document, including a timetable related to the proposal, within 21 days after Thursday's announcement. It will need to receive approval by at least 75% of the voting rights held by minority shareholders, which are kind of scattered across some investment funds. Regulators will also scrutinize the deal, and the High Court of Hong Kong will need to make some decisions too. HSBC expects the privatization deal to conclude in the first half of 2026. Then, Hang Seng Bank will end its listing status of 53 years. For Hang Seng Bank's investors, some would benefit from this offer price at 155 Hong Kong dollars per share, which was 30% higher than Wednesday's closing price and represented a 49% premium on Hang Seng Bank's average share price in the last 12 months, HSBC said. However, the business outlook is uncertain. For HSBC's shareholders, they're likely taking a short-term loss as the share price experienced some volatility with this bid and a hold of share buybacks in the next 3 quarters. In the long term, if the management delivers its promise, then they're still good to reap some benefits such as higher earnings per share. Investors will surely be watching closely the details and execution of the deal.